Good morning, everyone, and thank you for joining us today. On behalf of Equus Energy, I'd like to welcome you to this investor webinar. Today's session is in listen mode only. If you have a question at any point, please type it into the chat box and we'll address it during the Q&A at the end of the presentation. Presenting today is Managing Director Will Barker, who will provide an update on Equus Energy following the company's commencement of trading on the ASX. I'll now hand over to Will to run through the presentation. Thanks, Will.
Thanks a lot, Simon. And yeah, good day to everyone. Really appreciate you making the effort on effectively the last working day before Christmas. Great timing for us. We listed Equus just yesterday. Great response in the market following a very good roadshow and support of the $15 million capital raise during October and November. So we're really pleased to be listed and very happy to be here today to give you some background on the project, our plans around unlocking value from what is a very material reserve base sitting in the heart of the Australian LNG business on the Northwest Shelf. Very quickly, my background, I'm a geologist by training. I've spent the last 25 years in the industry. Worked a lot on the East Coast in the coal seam gas to LNG business. Worked with Arrow Energy there as the general manager of LNG, leading the developments out of the Surat Basin into Gladstone. And then when that was taken over by Shell and PetroChina, a colleague of mine, Andrew Leibovich, and I, who had both been at Arrow, decided to step out, having seen that huge value creation in Queensland, where large reserve met big LNG market, and saw all the majors come in and buy out the local companies. Andrew and I stepped out and started building our own businesses, initially onshore in Australia and in Africa, and then moving into offshore development assets. Ultimately, we ended up acquiring the Equus Gas Project, sitting there on the Northwest Shelf between the supergiant fields of Gorgon, Io Giants, and now the latest and final mega development on the Northwest Shelf being Scarborough, being led by Woodside with their Japanese partners, JERA and LNG Japan. But what we secured was 100% control of the Equus project, sitting there between those two fields. It had originally been secured by a big American company called Hess, which just got taken over by Chevron recently. But we'd been their partner onshore for a number of years, had great relations with them. And when they got into financial trouble during the oil price crash in 2015, a couple of years later, we secured 100% control. And that's now what has been vendored in to form Equus Energy. So Equus Energy, newly listed entity, controls 100% of the Equus project. It's a very material reserve base, 1.7 trillion cubic feet of gas, nearly 40 million barrels of condensate. So the equivalent of around 320 million barrels of oil combined. So very material reserve base, one that is the last, now that Scarborough is being developed, it is the last multi-TCF fields that aren't controlled by Chevron. So it puts us in a great position to be able to tie in and backfill the infrastructure. Over $1.5 billion was invested by Hess in the asset. They drilled 17 exploration wells, undertook then all of the appraisal drilling, drilled another 4 appraisal wells, undertook long-term dynamic production testing, and booked that certified resource base. It's a large enough resource to be able to produce 2 million tonnes of LNG and 50 terajoules a day of domestic gas for a 15-year project life. Where we're located is key for this asset. We are, as I said, in the heart of the Australian oil and gas industry, the heart of our LNG industry. Between Karratha and Onslow, there is 50 million tonnes of LNG processing capacity. That's 12.5% of the entire global supply. So it's a huge amount of infrastructure that has been absolutely dominated by the majors: Chevron, Shell, Woodside, BP, ExxonMobil have been the majors that have controlled this basin for the past 30 years. However, now after 30 years of production, it's in steep decline. The Northwest Shelf, the original development, has run out of gas. They shut in their first train early this year and have a series of closures where they are going to have to mothball infrastructure if they can't get new supply. That provides us with the opportunity to develop Equus as a capital light development where we develop the upstream, but we tie into existing infrastructure to come ashore and then use the existing LNG facilities and pipelines to sell our product both domestically and into the international market. The timing is right. We're in a position now where we have proven reserves and the infrastructure is spare and needs new supply to fill it. To help us do that, in September this year, we secured a funding and gas offtake agreement with Alcoa. Alcoa, being the largest gas buyer here in WA and one of the largest the largest in the country, they are providing us with $46 million in pre-final investment decision funding. So that's the final funding to undertake the pre-feed studies, the feed engineering, regulatory approvals, all the work we need to get this project through to an investment decision. In return, what they're securing is a domestic gas supply. So in WA, we have the domestic reservation policy, which requires us to supply 15% domestically. We have secured state conditional approval for our development plan that enables us to produce 15% domestically, then export 85% as LNG and export all of our condensate. The capital raise has gone extremely well. We were multiples oversubscribed on the $15 million raising, and we're very happy to get listed yesterday and sneak it in just before Chrissy. Capital structure in Equus Energy. The vendors, being myself and my business partners, control 40% of the company. So we are extremely aligned to shareholder outcomes and are driven to realise value for everyone involved. The new shareholders have also secured 37% of the company, and we're in a very strong financial position. We have not only the capital from the previous Shell copper strike and the capital raising, but we're drawing down our funding from Alcoa, and we have just under $18 million in the bank right now. With our ongoing funding support from Alcoa, as well as that $15 million from the capital raise, it provides us with multiple years, the next 2.5 years plus of funding to be able to unlock the value of these reserves, advance it forward towards a final investment decision, but importantly, be able to sell down portions of that asset to have liquidity events for shareholders. As I mentioned, the Northwest Shelf and the gas supply situation in WA is one that is leading into a position of very large shortages of supply. You hear a lot about gas shortages on the East Coast, but the WA market is a very large market. As we said, we're the largest LNG exporter in the country. We have also a very large domestic gas market with all of the mineral processing that occurs in the state. However, the supplies are in now short supply. So the Northwest Shelf, the original Karratha gas plant, a 17 million tonne per annum facility, is now in steep decline. So you have some additional gas from Pluto and Waitsia. So the Waitsia is the Mitsui and Beach development that are helping replace a slither of that. But by 2030, there's over 10 million tonnes or 1,500 terajoules a day of shortfall. The domestic market is also in short supply. with the government predicting by the early 2030s nearly 200 terajoules of undersupply. That's 20% of the domestic market here in WA, which is critical for our mineral processing and our power generation, especially as our coal facilities come off production. Combined, to put it in perspective, that underutilization of LNG facilities plus the domestic market shortfalls is in the order of 2,000 terajoules a day of undersupply. That's double the West Australian domestic market, or nearly 2.5 times the Victorian and New South Wales domestic markets combined. So that's going to lead to a real price crunch in WA and really exacerbate the need for new supply into those LNG facilities in particular, to keep them full, keep jobs in regional areas, and keep our export income coming from LNG. That's realised obviously by Alcoa. As I said, they're the largest gas buyer in the country. Here in WA, they consume over 200 terajoules a day, or 20% of the entire domestic market. What they've come in to do is to help facilitate Equus getting forward to that final investment decision so that they can get those exclusive rights to the domestic supply. In return, they're providing us with that 30 million US, or nearly 46 million Aussie dollars. In return, they get the rights to buy 50 terajoules a day for a 10-year period. So that's 15% of our volume supply. They get a discount to the long-term LNG, long-term domestic pricing. But what they're putting up is that risk capital, that 30 million US. It's not a debt facility. It's not even a prepayment on gas supply. It's an option fee. So it's an exclusivity fee to secure those rights. What they really want is that long-term, that 10-year supply and that certainty of supply that they can't get from the likes of Woodside and Chevron, who dominate the market here. What we're doing with that capital is it's funding all of the technical feasibility, the commercial activities around partnering, and the regulatory approval processes. It puts us in a really strong financial position as the 100% owner of the asset to be able to bring in the critical element, which is the partners, the big operating partners that have the balance sheet and the operating capability to run an offshore asset, as well as the big LNG buyers like the Japanese, the Koreans, the Chinese buyers, who all want to secure Northwest Shelf gas. What we kicked off in September was our pre-FEED studies. So that's updating our development plan based on the connections into Woodside and Santos's infrastructure, and updating the project costs and economics. That will lead us into, in the first quarter next year, completing an information memorandum, establishing a data room, and running a strategic partnering process. The key element we want to bring in is we're in that great position that with 100% equity, we want to sell down and bring in an operating partner initially. So one of the big operators like the Santos's or Woodsides of this world who need to fill their infrastructure, or one of the new entrants or existing regional operators that want to get exposure to LNG in Australia, which is an industry that is, as I said, has been dominated by the majors for 30 years. What we'll be running then from Q2 next year is that partnering process, which will then lead into the final FEED studies before an investment decision. The development path for this asset, as I said, is a tie-back development, making it as capital efficient as possible and leveraging the existing infrastructure and that great location we're in on the Northwest Shelf. we have multiple processing agreements in place. Key one that we're showing here is a connection into the Pluto platform operated by Woodside, along with their partners EIG and the Japanese buyers. From there, for upstream, we would have subsea wells tied into an FPSO. We strip out the condensate, and then we send gas through a pipeline to connect into the Pluto platform. Woodside would then take operatorship. They transport our gas to shore, where it can be liquefied in Pluto Train 1 and via the interconnecting pipeline through to the Karratha gas plant, where we have a secondary processing agreement with the other Woodside-led joint venture, which is the original North West Shelf joint venture. So it also then connects us into the domestic pipeline, the Dampier to Bunbury pipeline. So from one offshore connection, we're able to connect to 27 million tonnes of processing capacity, the export capacity that comes with, as well as the pipeline network into the WA market. We have another processing agreement in place, which is with Santos via their Varanus Island gas facility, which enables us to connect into their onshore infrastructure, process our gas, and send it to both the LNG infrastructure as well as the domestic market. That provides us with great selection of operators, of different routes to market, but what we maintain in all situations is the rights over our molecules, so that we are undertaking that processing through existing infrastructure operated by one of the major operators globally, but we importantly pick up our own product and market our own LNG to those big customers who want to get exposure to supply out of Australia. Turning to the value proposition and where we have positioned Equus as a new listing. We, sitting there amongst our listed oil and gas peers, we have on listing a market capitalisation at 20 cents yesterday, put us at a $41 million market cap. Our reserve base is large. We have a proven contingent resource base of over 320 million barrels of oil, which, if you compare it to some of our other major operators in Australia, like an Amplitude, who are in the Bass Strait, they're sitting there at around 80 million barrels compared to our 340. A Strike in the Perth Basin at just over 110 million barrels. A Finder, who have been having some great success with their project in Timor, sitting there at around 25-30 million barrels. So very large reserve base, and when we look at it on a dollars per barrel of oil equivalent, on listing at 20 cents, that values us at 13 cents Aussie a barrel of oil. All of our peers who are discovered undeveloped, like a FAR, like a Tamboran, like a Finder, they are sitting there in that $1 to $3 a barrel equivalent. Once you move into the production realm, you're up there in that $6 to $10 a barrel range, which is where a lot of the M&A activity takes place, both in the Northwest Shelf. The Perth Basin is always around that $5 to $8 to $10 a barrel of oil equivalent. So we've positioned this in a way where we secured the capital that provides us with the corporate funding to drive the project forward, bring in those partners, bring in those liquidity events while we're maturing the project, with that ability to really strongly re-rate. You're looking at that ability right now to start re-rating as we build momentum around the story, to be alongside our peers in that $1 to $3 range, and then as we unlock more value from the asset, to jump into that multi-dollar range. So to wrap up, we're extremely pleased to be listed. We have what we think is a really strategic project located there in the heart of the Northwest Shelf. We have great funding partners with Alcoa providing the 30 million US to fund us through all of the technical and regulatory work program. We have our capital in place now from the IPO, which provides us with the corporate funding to undertake the marketing and the partnering exercises we need. And we have the domestic offtake, and we have the routes to market through the existing infrastructure. So I really appreciate everyone's interest, and I welcome any questions you may have.
Yeah, thanks, Will. Just to reiterate, if you've got any questions, please submit them into the chat box, and we'll get through as many as we can. Look, we had a couple come in before the start of the webinar, Will, and the first one is just about the developing multiple smaller gas fields rather than a single large field. Is that a risk, or is that a positive? Is that a negative? Can you sort of...
Yeah, really good question. The last major, these are called supergiant fields. A field like Iogant's 22 trillion cubic feet of gas. It's about 3 billion barrels of oil equivalent. So they are rarities. Scarborough was drilled before I was born in the mid 70s. So, and it's only getting into development now. However, it was the last of those mega fields left. As I said, that goes into production next year, and it will meet the needs of gas into the Pluto LNG plant. All of the other fields are now in depletion. The Gorgon project, they just took FID to backfill Gorgon on 8 small satellite fields. So those big supergiant fields are no more. They're all gone. They were drilled in the 70s and the 80s and have been depleted. So Equus is very material. Globally, it's nearly that 320 million barrels plus of reserves combined. But that's where, yes, they're smaller fields. They're not the super giant, but they are very economically viable. They can be tied together and brought back into existing infrastructure to backfill it, and is exactly what the likes of Woodside and Chevron are doing now to keep their LNG infrastructure full.
All right, thank you. Just another one that's come through. In terms of the 15% domestic, 85% export, and you sort of talked about the shortfall, is there potential where you would look at having more domestic, or is it just not economical?
No, it's as I said, there's a shortages within the WA market that need to be met. Your LNG is a premium product, but as we've seen on the East Coast, when you get this combination of over capacity in LNG export, which was built in Gladstone, combined with what it does is a tight domestic market, it ends up bringing your domestic price to effectively parity, LNG netback, they call it. So that's why we're seeing gas price on the East Coast in that $12, $13 range. Currently here in WA, gas prices domestically are in around the $8, $7 to $8 a range in Aussie dollars. So I think we'll see a tightening of that increasing domestic gas prices in WA, which makes it appealing to supply into. But key thing is we got LNG infrastructure that's going spare in WA, and that ability to use that cheaply via a toll to get both a combination of export products and domestic. Whether that's 85-15, or you might look at your 30-70 mix of domestic and export, really comes down to the partners you're working with.
Yep, makes sense. The one that's come through, the EQU value proposition, investment rationale, and narrative is very strong. However, the rebirth of this asset and story is not very well known. Can you share more details around the marketing plan to highlight EQU?
Yeah, good point. We've been private for the last 7 going on 8 years. And we've kept our head low while we put in place all the elements. As I said, projects like Scarborough, it sat there for 40 odd years until you get the right combination of availability of infrastructure, market needs to bring those projects into development. Where we sit right now as that the only remaining multi-TCF fields on the Northwest Shelf, 100% owned by a junior. It's quite rare. Well, it's extremely rare. So I think that person's question is a really good one. It's now that we've got those elements in place, we have access to the infrastructure, we have a market need for those molecules to now be developed, to fill infrastructure, to meet domestic demand, to meet international demand. So our job and part of this listing is to get us out there now that that timing's right, to build awareness of the asset, both from an industry point of view and from a market point of view, to get those partners in place and unlock the value of the reserves.
Yep. Just in terms of you talked about selling down, what are those partners going to need to see from you ideally in order for them to, I guess, get involved? And when would that happen? Ideally.
Yeah, ideally tomorrow, but these are big projects. So what we're doing, and that's exactly why Alcoa have come in and provided that funding, is what we're doing is taking, the last time the development plans were put together was 2019, 2020, which we were doing just in the lead up to COVID. And when COVID hit, we got shut down from running that partnering process. So now the conditions within the market are right. What we're doing is utilizing that Alcoa money to update the development plan, update the costs, update the economic model, develop an information memorandum, a business case that we can then go in from Q2 next year, go launch that partnering process. As I mentioned, the key partner for us with all these big projects is we want to bring in an operator. So, whether that's, as I said, one of the existing Australian operators, could be a Woodside who need our gas to fill their infrastructure, could be a Santos who need the gas to fill their infrastructure, could be a player like Beach whose Waitsia project can't export from the end of 2028, or any of the international players that have the upstream operating capability to develop a traditional gas project, but one that can be tied back offshore to existing LNG plants. And therefore, they're not selling just a domestic product. They're getting that really valuable product, which is that LNG, to either take back to Japan markets or Korean markets or Chinese markets. So we want to bring in that operating partner. That then really further ratchets up the value of the asset by having that strong operating partner then. If we bring someone in at, say, 50% or even more, it still leaves us with a lot of equity to then sell down further to the traditional non-operating partners in these assets. So an example would be the Scarborough development. That has Woodside took it through to a final investment decision. They then sold down at a premium to JERA, the largest Japanese LNG buyer. LNG Japan bought in, so they took 25% between them and paid an absolute premium to secure that. You then have new entrants into the markets. Big funds like GIP, Global Infrastructure Partners, they are funding the Pluto LNG plant, Train 2, for Woodside, put over $5 billion into that. EIG, who have tried to buy out Santos, They bought an interest in the Pluto development as well. You then got groups like Carlyle, the big fund, trying to acquire assets in the country. So there's different financial markets and industry players who are keen to get involved in assets like this.
All right, thanks, Will, and thanks everyone who joined us today. I'll just hand back to Will for any final comments before we close.
No, thank you. Really appreciate the interest. Have a great Chrissy and look forward to getting out on the road in the new year and meeting as many investors as possible.
Thank you.